Welcome to the deep dive. Today, we're taking a close look at something that, well, it touches all our lives, the current economic climate.
Right.
And we're putting a special focus on the U.S. housing market.
Which is definitely feeling the shifts.
Absolutely. We've pulled together some really insightful sources for this. We've got Dr. Rajiv Dhawan's Economic Update from MarketWatch, presented just recently, June 12th, 2025,
Hmm.
and John Hunt's Market Watch, June 2025, from Market Insight.
Two really valuable perspectives there.
Our mission today, really, is to cut through the noise. Let's unpack what's truly going on beneath those headlines.
Yeah, connect the dots.
Exactly. Connecting global shifts, things like tariff jitters, federal spending, right down to the commercial stuff, like housing affordability, inventory, across the nation, but with a special look at Atlanta.
And I think our aim here is really to synthesize these sources, connect those big macroeconomic trends to your daily life.
Yeah.
I want to give you a clearer picture, not just of what's happening, but maybe more importantly, why it matters to you.
The why is key.
We'll explore that interconnectedness, how all these factors influence each other. Hopefully, give you a more well-rounded understanding.
Okay, let's unpack this then. Dr. Dhawan observes something he calls a short period of economic stasis interspersed with market yips.
Right.
That sounds, well, a bit dramatic maybe. What exactly does stasis mean here, and what are these market yips?
Well, stasis is basically Dhawan's term for stagnant economic growth.
Yeah.
A pause. Things aren't really moving forward much,
Okay, not growing.
but not necessarily crashing either. And the yips, those are those sudden, almost jumpy reactions in the market. Jitters, anxiety, usually driven by uncertainty.
Got it. And he talks about a hard versus soft data duel.
Yeah, and what's striking right now is how that softer economic data, things like small business optimism after elections, consumer sentiment.
How people feel about the economy. Their 401ks maybe.
Exactly. That stuff has become, as he puts it, a casualty of the tariff jitters. So the outlook for services, think healthcare, travel, even eating out, that's expected to sort of fizzle by early summer.
Fizzle out. Okay, so if consumers and small businesses are feeling jittery, what about the big players, large firms? How are they reacting?
Well, large firms were already pretty gun-shy about hiring over the last couple of years.
Right.
And now our sources suggest they're facing what Dhawan calls tariff-induced paralysis.
Paralysis, that sounds serious.
It means they're hitting pause, especially on capital expenditure spending. That's, big investments in equipment, tech, expansion.
So holding back on big spending projects.
Exactly. And that paralysis is expected to last into early 2026. But there's a bit of a cushion.
Oh,
Post-pandemic labor hoarding. Companies are still holding on to employees, remembering how hard it was to hire.
right, scared of shortages later.
Precisely. So that should temper outright mass layoffs, hopefully preventing a huge employment collapse.
Okay, so definitely a mixed bag of signals out there. It's not all doom and gloom, but not exactly rosy either.
That sums it up pretty well.
And speaking of big forces, federal spending, that's another huge piece. We've heard talk of one big, beautiful bill. What could that mean?
Yeah, that phrase has been floated. A potential bill, maybe around the 4th of July, could lead to what's described as shock and awe workforce reduction efforts.
Shock and awe. That means big cuts.
Significant, rapid cuts in federal jobs,
Right.
essentially. And that would have really quick downstream effects.
How so?
Well, it impacts state spending, local city jobs. Federal money ripples through local economies, And this reduction also has a fallout on the housing market. It could be pretty severe in some places.
But Atlanta,
Yeah?
you mentioned Atlanta might be different. It seems to have some factors that could soften that blow.
That's right. The hit to Atlanta's growth seems notably mitigated by a few unique things. One is a huge data center building boom.
Data centers, like for cloud computing and stuff.
Exactly. Massive digital infrastructure hubs. They attract tech investment, high-paying jobs.
Yeah.
It creates a powerful economic buffer.
Interesting. So while other places might slow down,
Atlanta's got this construction engine running. Now, Northern Virginia still has more total capacity, way more, but Atlanta is expanding its footprint really fast.
yeah.
Plus, you've got other factors like rebuilding after the LA fires and just a continued influx of people moving in.
Migration is still strong there.
Yeah, all helping to cushion Atlanta's economy.
Okay, let's switch gears slightly. Tariffs. Dr. Dawn calls it the new tariff game. Is this directly pushing up prices for us, for consumers right now?
Well, what's fascinating, and maybe a bit counterintuitive, is that the source suggests it's not much inflationary directly. Not in the short term for consumer prices.
Really? So tariffs aren't making everything more expensive immediately?
Not directly, according to this analysis. But the cost shows up elsewhere. It shows up in higher long bond yields predicted for 2027.
Higher bond yields, even though the Fed is cutting rates.
Exactly. Despite aggressive Fed rate cuts expected to start this summer, maybe totaling 200 basis points by next spring.
Okay, that is interesting. Why would bond yields go up if the Fed's cutting rates so much?
It's a great question. Dr. Dewan uses what he calls a calibration tool, essentially his economic model, to explain this.
A calibration tool.
Okay. And it suggests the reason for, say, a potential 75 basis point rise in bond yields is, well, it's about the trade deficit.
How does the trade deficit connect to bond yields?
Okay, so the idea is if we reduce our trade deficit, meaning we import less, then fewer U.S. dollars flow out to other countries.
Right.
And those dollars often come back. Foreign countries use them to buy our stuff, our treasury bonds, our stocks, even real estate.
Ah, they reinvest here.
Exactly. So if there are less dollars from reduced trade deficit, as Dewan puts it, available to buy our bonds.
Then demand for our bonds drops.
Precisely.
Huh.
Which means the government have to offer higher interest rates, higher yields on those bonds to attract buyers.
So a smaller trade deficit could actually mean higher borrowing costs for the U.S. government down the road.
Wow. It's a complete dynamic. It reminds you of what economists like Milton Friedman warned about tariffs back in '76. He said they protect consumers against one thing: low prices.
Protects you from low prices. That's a way to put it.
And Holman Jenkins at the Wall Street Journal had a colorful take too, suggesting a high-budget trade war might bomb with financial markets.
Okay, so the market effects might be bigger than the immediate inflation effects. What's the Federal Reserve saying about inflation and tariffs right now?
Well, you have different views. Christopher Waller, a Fed member, believes any tariffs will only modestly increase prices and it won't be persistent.
So a small, temporary bump.
That's his take. But Fed Chair Jerome Powell acknowledges it's tricky. He said the Fed's goals, maximum employment and stable prices, might be in tension.
Meaning they might have to choose which one to prioritize.
Potentially, yeah. It highlights the balancing act they face.
Just to give us a sense of scale here.
Yeah.
How big are we talking with this trade deficit and our national debt? Put in perspective.
Okay, numbers. The U.S. goods trade deficit in 2024 was huge. $1,211.7 billion.
Over $1 trillion.
Yep. Biggest deficits with China, Mexico, Vietnam. And the so what is that this massive outflow or potential reduction in outflow directly plays into those bond market dynamics we talked about.
And the debt.
Total Treasury debt in 2023 stood at $26,872 billion.
Wow.
Which is a massive jump from, say, $7,778 billion back in 2006.
Okay.
So the sheer scale of the debt and the deficit, combined with these changing trade flows, it creates a really complex financial backdrop that affects borrowing costs for everyone.
Right. It all connects. Okay. Understanding these big national currents is vital, but let's bring it home. Let's zoom into the U.S. housing market.
Definitely where many people feel these shifts most directly.
Market Insight describes it as back to a rate-driven market. And apparently their forecast from last December was spot on, saying we're still on par with last year despite all the tariff talk.
Yeah, they nailed that one.
So what's the biggest shift happening right now? What makes the housing market feel so different?
I think the single biggest thing is that the lock-in effect is over.
The lock-in effect, where everyone held onto their super low mortgage rates.
Exactly. People felt stuck, unwilling to move, and faced much higher rates. But that's changing. We're now seeing resale inventory existing homes for sale in several big markets, actually exceeding pre-COVID levels.
More homes on the market.
Yes. And that's not just numbers. It fundamentally changes the dynamic. Buyers might actually have a bit more leverage again.
For the first time in a while.
And for sellers. It means, a return to maybe more normal market conditions. Competition for buyers is back.
Okay, so more inventory. That sounds like good news, generally. But then we hear permits for new construction are declining across the board.
Right.
That seems contradictory. What's that telling us?
It does seem counterintuitive at first glance, but permits declining points to a deeper, more systemic issue. Market Insight calls it a sea change in the struggle for housing affordability in the U.S.
A sea change. It's not just inventory levels. It's can people actually afford a home?
That's the crux of it.
So what's really driving this affordability challenge then, if it's not just a simple lack of houses overall?
Well, Robert Dietz, the chief economist at the NAHB, the Home Builders Association, he points out that entry-level buyers are actually driving a lot of the activity that is happening.
Okay.
Sales of homes in the, say, $200,000 to $300,000 range saw a big jump last fall compared to the year before.
So there's demand at the lower end.
Huge demand.
Yeah.
But builders, they face massive headwinds. High land costs, labor shortages are still a thing, rising material prices.
Well, the usual suspects, but maybe amplified.
Exactly. And the key insight here from Dietz is that the markets that are going to grow are ones where builders can add that entry-level product. We desperately need more homes people can actually afford.
We hear people talk about drive till you qualify, right? Moving further out to find something affordable. Is that really the answer? Or is there something else emerging?
Drive till you qualify is definitely a strategy people have been forced into. But a really crucial insight from Market Insight is the need to simply build smaller homes.
Build smaller.
Yeah. Look at Atlanta's numbers from 2019 to 2024. The average price for a new home jumped 42%. 42%.
Wow. Okay.
From about $347K to nearly $494K. But guess how much the average square footage increased?
Not 42%.
Not even close. Only 7%. From 2070 square feet to 2210.
So prices went way up, but the size barely changed.
Which means the price per square foot, the PPSF, shot up 33%. So to afford even a $350,000 home today, at Atlanta's current new home, PPSF, you'd need a house around every 366 square feet.
Much smaller than the average new build.
Significantly smaller.
So, okay, the market needs smaller, more affordable homes. We're generally building bigger, more expensive ones. What's stopping builders from meeting that demand? What's the blockage?
This gets right to the heart of it, and it brings up zoning.
Zoning. Always comes back to zoning, doesn't it?
It really does. Market Insight argues our current zoning is based on the demographic makeup of the world 20, 40 years ago. It's fundamentally outdated.
How so?
There's what they call a missing middle in housing. We need more diverse types of homes, smaller single-family detached houses, yes, like 1750, 1500, 1250 square feet.
Okay.
But also duplexes, townhomes, small apartment buildings, things that add density gently. But most cities are actually predisposed against density.
Predisposed against it. Why?
Well, existing homeowners have been, and Market Insight uses the phrase frighteningly effective at restricting housing supply.
Frighteningly effective.
Yeah, showing up at zoning meetings, often very organized, sometimes with pre-printed T-shirts, vehemently protesting changes.
And the driving concern is often
the fear that building smaller homes will bring our values down, that adding density or smaller units will negatively impact their own property values.
So is it fair to say then, as Market Insight does, that it's an indisputable fact that we have a housing shortage of epic proportions in this country? And it sounds like it might be kind of self-inflicted.
Yeah, that's a powerful claim in the source material. And yeah, the data strongly suggests we have a major shortage. And this artificial restriction of supply, driven largely by exclusionary zoning, it is driving prices beyond people's budgets for rent or for sale, and the bigger picture consequence. This will greatly impact our ability to attract new industry and investment.
Which hurts everyone in the long run. Job growth, economic vitality.
Absolutely. It's a major economic bottleneck.
Okay, that's a pretty stark picture. Is there any good news?
Yeah.
Any signs of progress? Market Insight did highlight an Atlanta success story in Barrow County.
Yes, a little glimmer of hope there. It is close to 4-3 vote by the Board of Commissioners, but they approved a rezone for 249 single-family homes.
And the key part.
The square footage, 1,100 to 1,350 square feet. Small, attainable homes.
Wow.
This is huge because it's the first project like this approved in Barrow County in about 15 years without their usual 2,000 square foot minimum.
15 years. That shows how entrenched those minimums are.
It really does. And these homes are planned to sell from around $319K to $349K.
Which is much closer to that entry-level need.
Exactly. And interestingly, the BOC asked the developers not to call them affordable homes.
Oh, what did they want them called?
Attainable.
Attainable. That's a subtle shift in language, but maybe significant? Less loaded, perhaps?
Possibly. It reflects the sensitivity around the issue, but also acknowledges the goal.
Okay, so Atlanta is often a bellwether. How are permits looking overall there? Still declining like elsewhere?
Yes, Atlanta's permit trends are mirroring other big Sunbelt cities like Houston and Dallas. There's a noticeable decline, especially in 2023-2024.
And the reasons?
Primarily high interest rates initially, but now Market Insight adds tariffs and uncertainty to the mix, slowing things down further.
But you mentioned New York City as a potential roadmap. What are they doing differently?
Right. NYC's City of Yes for Housing Opportunity initiative. It's a really ambitious set of zoning changes. It's kind of an all options on the table approach.
All options? Like what?
They're really embracing those missing middle ideas, encouraging density, allowing lots of different housing types, focusing on walkability and transit access.
Okay.
They're also pushing for conversions of old office buildings, which is a big topic everywhere.
Makes sense.
Plus, they're putting money into infrastructure, offering tax incentives, using state grants, rolling back parking mandates.
Rolling back parking mandates, that's usually controversial.
Very. But their Zone 1 will become the most populous parking mandate-free area in the U.S., nearly triple the population of Austin, apparently.
Wow.
And they're trying to streamline approvals, environmental reviews, permits across different agencies, just trying to cut the red tape.
So a really comprehensive push to just enable more building of all types.
That's the goal. Whether it works remains to be seen, but it's a bold attempt.
Okay, let's circle back to inventory and sales. You said the lock-in effect is over for resale homes. How's that actually playing out in the numbers?
Yeah, resale inventory is definitely up, exceeding pre-COVID levels. Market Insight does something pretty unique here. They break down pending sales, differentiating between new and resale homes, and also by price point.
Okay, that sounds useful. What does it show?
Well, resale pending sales, they were negative for 2 straight years. Now they're basically flat year over year. So some stabilization there.
They're not coupling anyway.
Right. New home pending sales, though, are still down about 5% year over year.
Still struggling a bit. And by price.
Looking at Atlanta for 2024-2025, homes under $300K are down 6% year over year. Homes over $700, they're up 18%.
18%. Big jump at the top end.
Significant jump. And that middle range, 300K to 700K, is basically flat, up just 1%.
So the market's still hottest at the high end, while the lower, more affordable end is actually shrinking in terms of sales activity.
That's what the pending sales data suggests, yeah. Despite the demand we know exists there.
Which brings us back to the shortage. Given all this,
Yeah.
the zoning issues, the permit slowdowns, what does this mean for the actual housing deficit? Are we making any progress?
Unfortunately. No, not really making a dent yet. Atlanta, for example, currently has an estimated annual housing deficit of over 26,000 units.
26,000 units short every year.
Annually, yeah. And the current total months of supply is just 4.1 months. A balanced market is usually considered 6 months.
So it's still very much a seller's market in terms of supply, even with inventory rising.
Fundamentally, yes. And it's not just Atlanta. Charlotte has a deficit of over 25,000 units. Raleigh over 17,000. Major markets are facing significant shortfalls.
Where are we seeing the most activity then? Where a house is actually getting built and sold?
Market Insight predicts the hottest markets for home sales in 2025 will be where the most finished lots were sold to builders recently. That's where the pipeline is.
Makes sense. Where the builders have land ready to go.
Exactly. In Georgia, Gwinnett County leads by a fair margin, followed by Chatham, Savannah, and Houston County down near Macon. Those areas saw a lot of lot sales, suggesting that's where future supply, especially new homes, is likely to concentrate.
Okay, so let's try to wrap this all up. What does this mean for you, our listener? We've unpacked quite a bit here. An economy kind of stuck in stasis, feeling those market yips from tariff uncertainty.
Right.
Potential federal spending shifts that could hit local jobs and definitely impact housing. Then we dove deep into housing itself. The end of that lock-in effect, more resale homes, yes, but this critical, desperate need for missing middle, smaller, more attainable homes.
Running headlong into zoning battles.
Exactly, that ongoing fight against exclusionary zoning.
And if we zoom out one last time, that journey we talked about, from calling it affordable housing to attainable housing, it might seem like just words, semantics.
Yeah.
But it really reflects a fundamental shift, or maybe the need for a shift in how we think about housing policy, community growth, what we allow to be built.
It's about what's actually achievable in the current market.
Right. The data points pretty clearly to this epic housing shortage. And if we don't address it, if we don't change zoning, change how we build, it could really hold back our ability to attract new industries, maintain a vibrant economy for everybody.
It's a major economic anchor if we don't fix it. Okay, and here's where it gets really interesting, maybe a final thought for you to chew on.
Okay.
As we look ahead, with all these complex economic headwinds, this clear imperative to build more attainable housing, what might be the next unforeseen consequence? The ripple effect from all these shifts, economic, housing, zoning that maybe we aren't quite talking about yet. Could it reshape migration patterns even more drastically,
Hmm.
change the fundamental character of our cities and suburbs? Something to mull over.
Definitely food for thought.
That's all for this deep dive. We hope you feel a bit more well-informed, maybe better equipped to navigate these really complex topics.